Hello, class. This is Professor Reynolds. I hope you're enjoying this week so far, now that classes are over. Sorry about the mix-up. I thought classes ended Thursday, but apparently they ended yesterday. I wanted to put together just a quick little overview of what is going to probably be on the test. I'm here in my home office. You see the shelves behind me. I mentioned that I built a couple things, and that's one of them. I did build the shelves, but my wife gets responsibility for the decorating, which is her superpower. You can see here barely. This is the wooden replica of the submarine that I was on, one of the ones in the Navy, and then we have, of course, George here and World War II books. So anyway, that has nothing to do with the test, but so let's get started. We started with chapter 14, and that was an introduction to managerial accounting. Um, Let me see if I can hopefully, yes. So hopefully you can see me, but anyway, managerial accounting, of course, we were talking about um, focusing on internal information. So it's not regulated by GAAP, it's really regulated by what we really want to see and the information we need to help us make decisions. This chapter, though, focused a lot on the organization, but also on manufacturing. And so we'll talk about that. Here is the manager's role in the organization. You can see the board of directors, which are elected by the shareholders. And then the board of directors then appoint the chief CEO, vice president of, or chief financial officer, and chief operating officer. We talked about strategic planning, which is long-term goals, what products we want to create or to make or to sell, what countries we want to be in, where we want to position our company. Do we want to be like Walmart that sells everything, or do we want to be a piano company where we only produce high-end pianos? About the different companies, and I mentioned that you should be able to look at the financial statements, the income statement, and the balance sheet of a company and determine what type of company it is. Service companies won't have inventory. They may have supply costs, but they won't have inventory. So they will not have inventory on their balance sheet. They will not have cost of goods sold. Merchandising companies, what do? They sell products, so they have inventory. But they only have one type of inventory, and it would be merchandising inventory. So if you look at their statement, you're going to see cost of goods sold for the income statement, you're going to see inventory for the balance sheet. Manufacturing companies, they make products and they sell them to either merchandising companies or to individuals. So manufacturing companies are going to be the company that have the three types of inventory: raw material, work in process, finished goods. And so their income statement will have cost of goods sold. It may have items such as cost of goods available for sale, etc. So these are the three types of manufacturing inventory: raw materials, work in process, finished goods. We mentioned direct costs. So direct cost is a cost that can easily and cost effectively trace to a cost object. Raw materials would be that. Someone who their labor is only to produce products would be part of direct costs. And then we have manufacturing overhead. So those are all the costs that can't really easily be tied to a cost object. And that is one area that you really need to focus on. We talked about this is a slide that you should be familiar with. Okay, what is a period cost versus a product cost? A period cost means that we're going to expense it this month. A product cost means that it's going to be part of the product. So to be part of the product, is necessary to be in the manufacturing process. So depreciation on manufacturing equipment, obviously manufacturing overhead. Property taxes, insurance on the factory is manufacturing overhead because it deals with the factory. Whereas property taxes and insurance on the office are period costs because they're not part of the manufacturing process. I also mentioned that there might be HR people or accounting people where they may split their activities. So part of their cost would be period cost and part of it would be product cost. But you should be able to identify this. So you can see here the different balance sheets. Service company has no inventory. Merchandising company has merchandise inventory. Manufacturing company has raw materials, work in process, finished goods. Income statement. Service company will not have cost of goods sold. Merchandising company will have merchandising inventory and cost of goods sold. Manufacturing company will have finished goods and cost of goods sold. Here is sort of a chain as far as what these costs are. You should be familiar with this, whether it's raw materials, whether it's work in process, whether it's finished goods. You start with a quantity, you add to the quantity, and so that provides you a quantity that is available for use. You add those together, you subtract out what you have left over, and that is your cost of goods sold. There may be a problem related to something like, let's see this slide, where you'll be asked to predict the, well, I guess we'll get that in the next chapter. Okay, so I think we're done with